The last time we reviewed the Vanguard LifeStrategy 100 fund, we didn't have the best opinion of it, because it does a pretty poor job of tracking the global markets. The fund is generally overweighted to the UK and underallocated to the US. But what if this very flaw will make the LifeStrategy 100 fund the best global fund on Vanguard's UK platform? By looking at some key data, we're going to show you why the LifeStrategy 100 fund has a good chance of outperforming the global markets. We do just want to remind you though that we are not financial advisors, so if you want independent advice tailored to your own circumstances, then seek that from a professional. Before we show you why this could be the best performing fund over the next few years, let's take a few steps back and remind ourselves about the fund. The Vanguard LifeStrategy 100 fund is part of Vanguard's LifeStrategy range on the platform. It is a fund that has the highest percentage allocated to equities, 100% in fact, which means that it is the riskiest, but it also has the highest expected returns. It is operated in a very similar way to an index fund, as it has a NAV price. Just remember that this NAV price is not a minimum investment value though, because it's not like the ETFs. The ongoing charge for the fund is 0.22%, which is generally a bit lower than some of the other global funds on the platform. The paragraphs below explain some key information about the fund, and it explains why the LifeStrategy 100 fund is so different to other funds. It says, the fund gains exposure to shares by investing more than 90% of its assets in Vanguard passive funds that track an index. Direct investment in shares may also be made. This means that the fund is generally made up of a combination of other passive Vanguard index funds. But the fund does have the choice to invest in individual stocks should it want to. It then goes on to say that the fund is actively managed, in that the investment advisor has discretion in respect of the associated schemes in which the fund may invest and the allocations to them, each of which may change over time. Now, this is where it does get a little confusing because the phrase actively managed can be a little misleading. The fund is made up of a range of passive funds. However, somebody has to actively decide which of these passive funds are going to make up the LifeStrategy 100 fund. This is why they're saying it's actively managed. It's the exact same as you picking from a range of passive funds to make up your own portfolio. You're not necessarily investing in active funds, you're just making an active decision. This very aspect of a fund explains why the fund may outperform global markets, but more on that later. If you click on the Portfolio Data tab, you can see the funds that are held within the LifeStrategy 100 fund. There's a bit of everything, from UK funds, US funds, Pacific funds, and emerging markets funds. This is generally a good thing, because it means that the fund is globally diversified. However, the weightings for each country are very much different to that of a global index fund that tracks global markets. This table shows the weightings for the US and the UK for both the LifeStrategy 100 fund and the FTSE Global All Cap Index fund. It's worth noting that the FTSE Global All Cap Index fund is about as representative of the global markets as you can get, which is why we've chosen it as a baseline. The LifeStrategy 100 fund has quite a significant underweighting to US equities and an overallocation to UK equities. The US markets are underweighted by around 11%, whilst the UK markets are overallocated by around 21%. This means that the returns that you get from the LifeStrategy 100 fund are not going to be very representative of global markets. The fund was actually constructed this way on purpose, so that it'd appeal more to UK investors, because apparently us UK lot like funds that have a bit of a bias towards the UK. Who'd have thought? This is what we previously described as a flaw to the fund, because straying away from global markets is an active decision. When investing in the LifeStrategy 100 fund, you'd be hoping for the UK to perform better than US equities, as this is the direction that your portfolio would be tilted towards. But it is for this very reason that the LifeStrategy 100 fund may outperform global markets in the future. This ties in very closely to the discussion that we've been having recently about the future expected returns of the stock market. The future expected returns for the US markets are generally much lower than other global equities right now, because of the expensiveness of US equities. I'll quickly remind you of the graphs that we saw the other week from Vanguard, showing that future stock market and bond returns are looking poor. The key graphs to note are the two at the bottom. The one on the left shows that a 60-40 US equity portfolio has an averaged expected return of just 3.2%, whilst a non-US 60-40 portfolio has an average expected return of 6.1%. This is because of the counterbalancing effect that the stock market seems to have. US equities have performed amazingly over the past decade or so, which means that the prices are now high and the future expected returns are lower. Global equities, however, have underperformed in general, which means that their prices are low, so their future expected returns are high. The general expensiveness of an equity can be described by its price to earning ratio, or PE ratio for short. The PE ratio is a measure of how expensive a stock is in relation to the earnings per share for that equity. This graph shows the PE ratio of the S&P 500 from where records began, which can represent the US markets, showing that we are nearing all-time highs. The current PE ratio is 34.02, which is amazingly high. This can be compared to the PE ratio of the FTSE 100, which can represent UK markets. We have data from 1994 to 2021. You can see that the UK isn't anywhere near the spike that the US is showing, with the current PE ratio being just 14.8. This means that the PE ratio for US markets is almost 2.5 times more than the PE ratio for UK markets. Or in other words, the US is 2.5 times more expensive. However, this is just one pricing metric that we can use, and most people think that PE ratio is generally outdated. There is a more reputable metric, known as the CAPE ratio, or Shiller PE ratio, as it was popularised by Robert Shiller. CAPE stands for Cyclically Adjusted Price to Earnings Ratio, and it is a measure that uses the earnings per share over a 10-year period to smooth out fluctuations in corporate profits that occur over different periods of a business cycle. It is generally accepted as a better metric to tell whether a stock is overvalued or undervalued. So, what data do we have? This graph shows the Shiller PE ratio for the S&P 500 from when records began, but the results are just as bad. The PE ratio is the second highest it has ever been, behind the dot-com bubble, with a most recent value of 38.3. This funky rainbow graph shows the PE ratio for the FTSE 100 since 1988. The black line is the actual CAPE ratio value, which is currently at around 16. So again, we have 38.3 compared to 16. So even by the CAPE ratio, the US is over twice as expensive as UK equities right now. As we explained previously, if you're paying a higher price for something now, then the future expected returns are inherently lower. 38.3 is high, really high, meaning that the future expected returns will be lower. However, 16 is pretty low, meaning that the future expected returns for the UK will be higher. If we relate this back to the LifeStrategy 100 fund, we're overallocated in the UK and underallocated to the US, which sounds like great news for the fund. But at the end of the day, CAPE is just a number. So how good of a job does it actually do in predicting what future stock market returns are going to be? Michael Fink has a great article on this topic, which I'll make sure to link below. He starts off by discussing some research done by Vanguard. In 2012, Vanguard did some research on the S&P 500, showing that the R-squared value, or predictive ability of the CAPE ratio in determining the next 10 year of returns from 1926 to 2011 was 0.43. So the CAPE ratio could be used to predict 43% of the future 10-year returns, which isn't that accurate. But at the same time, it's not that bad either to say that it's predicting the stock market, which is supposed to be unpredictable. But at the end of the day, 43% predictive ability is not that conclusive. So maybe CAPE is just another useless metric. However, if you focus the data from the most recent 25 years, from 1995 to 2020, we can see that the CAPE ratio explained 90% of future 10-year returns. This graph shows the data. As you can see, as the CAPE ratio increases, the annual returns for the S&P 500 also decrease. The connection is about as strong as it gets. The CAPE ratio is predicting what the future stock market returns are going to be with 90% accuracy. Let that sink in. But if you're not convinced by the recent data, then you can expand the dataset from 1975 up to 2020. And again, it is accurate to 85%. This graph, and excuse the poor quality, shows how the R-squared, or predictive ability of the CAPE ratio, has changed over time. The more recent the data, the better the CAPE value predicts future 10-year returns. And we are in the most modern time possible, the present. So what does today's CAPE value correlate to in future expected returns for the next 10 years? With the current CAPE value of 38.3, that would correlate to around 1% returns when using the 1995 to 2020 data. In fact, this article didn't even take the CAPE up to above 34, which shows how ridiculously high it is right now. Each column here shows the expected returns when considering the CAPE's predictive ability for each time period. Whichever one you choose, the expected return for the next 10 years are low. If you were to try and estimate the FTSE 100 returns using this data, which currently has a CAPE ratio of about 16, then the future expected returns would be 13%. But perhaps this is a little too much of a prediction, as this data is relevant for the S&P 500, not for the FTSE 100. But either way, if you're using the CAPE ratio to try and predict future expected returns, then the future expected returns for the S&P 500 are going to be low, and the future expected returns for the FTSE 100 are going to be higher. Again, back to the LifeStrategy 100 fund, this reinforces the fact that it should outperform global markets over the next decade at least. Based on the data that we just looked into, more UK and less US is a good thing. So the Vanguard LifeStrategy 100 fund could be the best performing global fund on Vanguard over the next decade or so. But of course, nothing is guaranteed. At the end of the day, all of these PE ratios, CAPE ratios, and expected return values are just data. They're being used to make predictions. Predictions that aren't always going to be accurate. You can't be certain of anything in investing. If it was a 100% truth that the US markets would underperform UK markets over the next decade, then everybody would have sold out of the US markets when this information was available. But it's not happened yet. Predictions are just predictions. It all comes down to how much you believe that data and whether or not you believe it enough to act on that data. If you do want to act on that data, then adjust your portfolio accordingly, or invest in the LifeStrategy 100 fund because it basically does it for you. Because, in a sense, the LifeStrategy 100 fund can be seen as an active fund that is tilting towards the UK and away from the US. That could turn out to be a good thing, but who knows? I'm just presenting the data, and I certainly have no idea what is going to happen. If you think you do, then let us know in the comments. I'll see you next time, everyone.